Hello, welcome to another of our online meetups. For those of you who don't know me, my name is Dee Collins. I am the founder, editor and publisher of Focus magazine, a print and online lifestyle and business magazine for women. Today I am delighted to have award-winning Weekend Herald columnist, best-selling author and New Zealand's most trusted money expert, Mary Holm. Mary, welcome. So you're a best-selling author. You've written a number of books. Mary, the big question, how do we run our money better during these times and onwards?
For the most part, do nothing different from what you've done before. Just leave your money where it is in Kiwisaver accounts and in the bank. I mean, one of the issues that's arisen lately is that some people are quite nervous about the bank situation, about whether their bank is going to collapse in the middle of all of this. And the answer to that is almost certainly not. No indication that the New Zealand banks are under any kind of stress at the moment. And, as there'll be some businesses that are going to close in the coming months, of course, but the New Zealand banking system's way stronger than that. But if you're nervous about that and you've got a lot of money in a bank, it wouldn't be entirely stupid to spread your money as say your term deposits mature, to put some of the money in other banks if it's going to make you sleep more easily. Personally, I wouldn't bother. I'd just leave it all in one bank.
And that was a very big question. Are the banks safe?
Yes, yeah. I've been surprised actually at how many people are worried about that. The governor of the Reserve Bank, Adrian Orr, just said the other day, look, we've probably got the strongest banking system in the world. So I certainly wouldn't be worrying about that. Beyond that, if you're looking at your Kiwisaver account, let's say, if you're feeling panicky or just even unsettled by the fact that your Kiwisaver account balance has gone down in the last month or so, that tells you something about whether you're perhaps in the right account for you. If you're in a riskier account, either the balanced account is a sort of middle level, and you've got the growth accounts and the aggressive accounts, which are the riskiest of all, the ones with the biggest investments in shares, and they are the ones that have gone down the most in recent times. Although, let me just add to that, there's been quite a big recovery, and I don't think New Zealanders realise that. The New Zealand share market has now recovered, or as of yesterday, about 40% of what had dropped since late February. So it went down, but it's come almost half the way back up again already. That doesn't mean it's going to keep doing that by any means. It could easily go back down again for a while, quite easily, highly likely really in the next month. But in the long run, it's going to come back up again. They always do. Share markets always do, regardless of what's happened. There's never any way to know when the bottom is. That's another interesting group of letters I've had, is from people who are not freaked out by the fact that their balance has gone down. They're the opposite. They're thinking, now's my big chance to buy shares cheaply. And that's absolutely true. The only thing is that people quite often want to pick the bottom of the market. They say, well, especially if they've been watching the market lately and seeing that the New Zealand market has gone down and then come a fair way back up, do they rush in and buy now because it might keep on going up, or do they hang about and kind of hope it's going to go down some more? There's people, the top experts in the world can't get this right. The basic message is, don't try to time the markets. Go for walks. Don't look at your balance. I still haven't looked at. I got an email the other day with my Kiwisaver statement for the first quarter of the year, and I haven't bothered to open it yet. I thought, I'm busy. I've got other things to do right now. I'll open it at some point. In the long run, it'll keep climbing.
Why do you think there has been a big recovery in the New Zealand share market?
Collectively, we probably overreacted when in the downturn. From I think it's February the 20-something, the market clearly suddenly started heading downwards and kept going. And that's what often happens, that people see other people selling, so they get in and sell as well. And the market gets caught up in the madness of it, and more people keep selling. And then after a while, people start saying, I wonder if we've oversold. I wonder if, there are some bargains out there. I wonder if companies are in fact worth more than their current share price. I'm going to get back in and buy again. And so that's what causes the market to come back up. But we can only sit there and watch and guess, because it's just the majority. When the majority think things are getting worse, the market will go down. And when the majority think things are over, that there's been an overreaction, the market comes back up again.
Should mortgage payments be put on hold during this time if your income has reduced?
They have been, and in that, well, I shouldn't say that broadly. The banks have said, if you want to put your mortgage payments on hold for up to 6 months, just come to us. And there's apparently each bank's doing it slightly differently, so it's best to go onto the bank website and see what they're saying about doing it. But they're offering that option to everybody. And in a press release yesterday, the Bankers Association said it will not affect your credit rating. If in fact you're struggling to meet the mortgage payments, you can go and stop the payments for up to 6 months. Now, don't do that unless you need to, because it's not like you're getting they've been calling them mortgage holidays, and it's not a holiday. That's too positive a word to put on it. I'm talking about mortgage deferrals, because it just means the interest keeps running up on the loan even though you're not paying it. And so in the end, you're going to be paying off your mortgage for longer, and you're going to be paying more total interest on it. So it's not as if the banks are giving you anything, they're just kind of extending the loan out for a longer period. So I would suggest you don't rush into doing that. There are some sort of lesser steps you can take. Instead, you could perhaps just go to paying interest only on the mortgage. And how much that affects how much you pay depends how far through the mortgage you are. The way most mortgages are set up, in the early days of the mortgage, you're paying off mostly interest, because at that point you owe the bank a heck of a lot of money, and so most of it's interest. By the end of the mortgage, 20 or 30 years down the track, you're paying nearly all principal. The debt is much, much smaller by then, and so the interest is much smaller, and so you're paying just a tiny bit of interest and a lot of principal off. So if you go to paying interest only, that might cut your monthly or fortnightly mortgage bill a huge amount, or it might cut it barely at all. That's a kind of middle level thing to do. Rather than going on a total mortgage deferral, just pay interest only is one way to stop the interest from rolling on up in the meantime.
So I have a question from a 22-year-old whose expenses are currently low. He has just graduated, but wants to build an emergency fund for his future. Any advice for him?
In this situation, which is a crisis sort of situation for many people, this is when you spend your rainy day money. If you've got rainy day money that you've set aside, which is a great idea, and you're losing your job or your pay's being cut, this is the rainy day. This is where you use the rainy day money rather than going on a mortgage deferral. Use up the rainy day money first, then go on the mortgage deferral. The easiest way to set up some kind of fund like that is to take a fairly small amount of money that you're to save at the beginning. So it's not, if you're suddenly trying to save, say, a quarter of your income, after a couple of weeks, you're probably going to say, this is just too hard, because suddenly you've got a whole lot less spending money. But if you take, say, 5 or 10% of your income, maybe 5 at the beginning, and set that aside, automatically transfer that into a savings account, and then set yourself up to increase that by, you might go from 5% to 7%, a month later, and then go up to 9, something like, just set yourself a very gradual increase in the amount of savings you do, and that way people find they can adjust to it. And after you've got $1,000 or something like that set aside in a bank savings account, then you might think about what else you might do with that money, because these days it's earning very little interest. The obvious thing to do would be to go into a bank term deposit. I know they're not paying terribly high interest either at the moment, but you want the money to be somewhere that you know is safe. So a bank term deposit for a month. And then if you've got a credit card as well, then 1 month term deposits work well, because any emergency spending you suddenly have to do, you can put on your credit card, and by the time you have to pay the credit card bill off, it's always a month after you've spent the money, at least. Then in that time, the 1 month's term deposit will have matured and you can use that money. But I really recommend people do it. So many New Zealanders have not got an emergency fund like that, and at times like these, when there's enough else to be worrying about at the moment, about our health, etc., without worrying about not being able to meet the power bill or something like that.
What is the best course of action for a large amount of money sitting in term deposit or simply a savings account with next to no interest?
That depends on when she's planning to spend that money. If it's within the next 2 or 3 years, I just recommend leaving money in bank term deposits, or possibly a very low risk Kiwisaver fund, which has got much the same sort of profile. You're going to earn much the same sort of interest, really, probably, as you do in bank term deposits. As I keep saying, that the rates are not good. What people have got to remember, though, when they complain about how low interest rates are currently, is that inflation is also very low. And in fact, I think inflation is still lower than what you're getting in bank term deposits. In fact, I'm sure it is in term deposits, not in savings accounts. It's got pathetic interest. So try and get into at least 1 month term deposits if you can speak, if you're not spending the money straight away. But the thing about inflation and interest rates, it's a really important point that a lot of people don't realize. Back in the 70s and 80s, we were earning interest something like 18% at some point, 17, 18%, which sounded fantastic. But inflation was actually higher than that. Inflation at some points was about 20%. And so what was happening, if you put $100 in the bank at the beginning of the year, at the end it might be $118. But by the time you took out that $118, it bought less than the $100 did at the beginning of the year, because inflation was even faster. And so when you think about it, the only thing that matters with money is what you can buy with it. It's not the actual number of dollars itself, it's what goods and services you can buy with that. So currently, even though interest rates are really low, you're still at the end of the year able to buy more with that money than you could at the beginning of the year. And so it's not as bad a deal as a lot of people think.
This is a bit of a long one from Steve, who'd heard you talking about some draft legislation proposing a guarantee for the first $50,000 of funds.
Yes.
Is this 50K per bank or just one lot per individual family household?
The details aren't all out yet, because the government's still finalising it. And by the way, back in December, they said it probably wouldn't even be in effect until 2023. So we're a long way away. But something that Adrian Ord said the other day makes me think that perhaps they might speed it up in light of the COVID crisis. But what they're looking at is the government would guarantee $50,000 per person per bank. There'd be no point in splitting your money up, because there's one guarantee. The guarantee covers one person in one bank, but it does only cover one bank, and so there is quite a good argument for putting your money over several different banks. This is once this insurance comes into effect. It's not in effect at the moment.
Is it now the time to buy the next door adjoining unit, cross lease, half undivided, or invest in the share market? She is 50 years old, mortgage free, and has some spare cash?
I'm not an expert on all this cross-lease business and so on. I don't know that detail of property. I can answer on whether this is a good time to buy property in general, and the answer to that is maybe. Unlike shares, where we really don't know whether they're going to go up from here or down from here, but with property, the experts, I was reading quite widely online, and the various economists, that no one's saying property is going to go up in the next while. They're all saying it's probably going to go down a bit. I couldn't find anyone who said more than 10%. So the general consensus seems to be that they think property prices will fall a bit. And exactly when the bottom will be, nobody knows. But just the sort of general lack of confidence of people out there suggests that fewer people are going to be rushing in to buy a first home, for example, or moving from a cheaper to a more expensive property. And in light of that, it mightn't be a bad idea to buy now, even though, you know, maybe wait and prices might go down some more. We don't know when the bottom is. But I think now might be quite a good time to be a tough negotiator. If you know someone who really does need to sell, don't like to suggest people swoop in and take advantage of that, but nonetheless, keeping in mind that the seller might have had huge gains on that property in the last 10 years, huge gains. So what I'm getting at is that they might be more open to quite a low offer than they might have been, say, a year ago. So, you know, now mightn't be a bad time for someone to go in and make quite low offers on properties and see what they can get that way.
Paul says he retired 3 weeks ago and has a 25-year work-related superannuation scheme, which has reduced in a month to 80% of its January value. Because he's now retired, he does not have the luxury of leaving his money in superannuation for, say, 10 years. He has other funds to tie him over for 2 to 3 years. Should he close the superannuation fund and withdraw his money, or keep it in for 2 or 3 years?
The idea in retirement is to have the money that you plan to spend within the next 3 years in low risk. So in bank term deposits or a very low risk Kiwisaver or other fund. Don't forget, people at any age can get into Kiwisaver. So if he wanted to have a look at a Kiwisaver fund, he could sign up for that now. So you want the money you're planning to spend for the next 3 years be in low risk, and from 3 to 10 roughly. So you're thinking about allocating your retirement savings over that period. That money can be in kind of middle risk, and then the money that you think you're going to be spending, you know, in your 80s and 90s can stay in high risk as long as you can cope with the fact that it will go up and down. But it's quite a good idea to leave it in there if you can cope with that, because you'll probably almost certainly make more money in the long run, higher average returns in those higher risk funds.
I have a question or a comment from Cindy. She heard you on national radio yesterday and said, I could feel your eyes roll when you mentioned those with between 100 to 200K who had money in bank deposits. So my question is, if you had that much money, how would you invest it, and how would a novice go about doing that?
Look, people who have got a lot of retirement money, you know, $500,000 or something like that, might well have a couple of $100,000 in a low risk investment that they're planning, if it's money they're planning to spend in the next few years. But if all your money is in very low risk, which isn't such as bank term deposits, and you're retired or near, or at any age actually, it's a good idea if you can find the courage to put some of it, the money that you're planning to spend more than 10 years away, in at least a medium risk Kiwisaver or other fund, because in the long run it will on average earn you more. It'll be, the higher the risk of the fund, the more ups and downs there'll be. If you've got a lot of money in bank term deposits and you hate the idea of seeing the money going down, and you've got enough to see you through your life, nothing wrong with just leaving it there, actually. although you might want to spread it around a couple of different banks if you're feeling nervous about the bank situation, just for peace of mind.
I bought a house just before lockdown, but wasn't able to sell or rent my old house in time. My new house was expensive, and I floated a portion or mortgage and fixed a portion. My income has dropped, so I'm taking the mortgage holiday but paying the interest. It was also recommended to me to withdraw most of my superannuation in the interim to offset the floating loan. Then once we're back into level 2, to sell my house and put my superannuation back. Do you have any alternative suggestions?
There's always going to be somebody caught, and this time it's been you. I don't have any brilliant suggestions. It's a good idea to go and talk to your bank. The banks always say this: if you're in a tight situation, please, rather than not meeting payments or something like that, come and talk to us. And the banks are saying loud and clear, we're going to be compassionate in these situations. So they won't give you a holiday as such, but they will sort of tide you through. But beyond that, I mean, Claire can probably be doing things perhaps to make her house, the one she wants to sell, particularly saleable, you know, making sure it looks great. Maybe she can use the time to, you know, I was going to say paint something, but it might be a bit hard to go and buy paint at the moment, actually. But at least smartening the place up and being all ready to go as soon as we get out of level 4. Good luck, Claire. Look, in the long run, and if you do need to eat into your emergency money at this point, well, that, as I said earlier, that's what it's there for, this sort of situation. It'll come right. Things will come right for you.
We managed to sell my late mother's house just days before the lockdown, and I now have $200,000 to invest from the settlement. I've popped it into an on-call term deposit while I figure out what to do. I own a rental property, so could pay down a chunk of the mortgage early, or maybe I should put it into a shares via an index tracking or managed fund.
I mean, normally I say to people, pay down the mortgage rather than invest elsewhere. But that argument is not quite so strong on an investment property, because the mortgage interest on an investment property is tax deductible, and that means that you're not really effectively paying as much on that mortgage, and therefore getting rid of that debt isn't quite as powerful. And the other issue at the moment is that mortgage interest rates are really quite low, and so if she hasn't got much in the way of share investments, it's quite a good idea to be in both, you know, property and shares. And so it mightn't be a bad idea to go into, I think she's talking about a low fee index fund or some other share fund. Whether you want to put a big sum into those, a fund like that at the moment is open to debate, because the markets could go down further. What I would probably do would be put about 1/3 of it in straight away, and 1/3 in perhaps a month's time, and 1/3 in 2 months' time. The idea with doing that kind of thing is that you end up not putting it all in at exactly the wrong time. And you look back on it, because we don't know which is the best time, but when you look back, you're going to say, oh, well, at least I got some of it in at a pretty good time.
Have you got any last words or advice, Mary?
It's not a good idea to be taking too much notice of what's going on with your investments at the moment. The one thing you can do is learn how well you tolerate market ups and downs. And if you're finding through this process that you really are worrying about it, then move your money gradually in, as we say, in say three tranches to where it should be, and then leave it there. Don't, when the markets start coming back up again and things settle down, as they will, don't then say, oh, perhaps I'll take a bit more risk again, because people who do that, who move in and out, always end up, nearly always end up worse off than people who just sit there and go for walks and read novels and do other things. In finance, it's not a good idea to be watching it too closely. It's much better to just get your settings right and then go and do other things with your life, much more important things. Go play with kids, something like that.
Mary, we so appreciate you taking the time to chat with us today.
Great pleasure, Dee. And I just want to say to everybody, I think it's sunny weather almost all over the country. So get outside, pick some flowers, yell over the fence at a neighbour and forget about your money. It'll be fine.
Great advice. Thank you all for listening. Thank you, Mary. Take care. Cheers now.